podcast. My name is Eitel, and I am the founder and lead analyst for Eitel Insights. Today we're going to be going over the Greater Vancouver's detached market. The new data for April just came out the other day, and we're going to be discussing it here shortly. And of course, sharing the charts with you. Just before we get into all that, we do ask that if you appreciate the content that we're producing for you and the charts that we make up, that you subscribe to the channel and give us a thumbs up on today's podcast as well. I am often reminded that I'm not exactly the best at social media from followers and clients as well. So yeah, totally true. I'm not devoted to figuring out all the social medias, but please feel free to share this content and any future content with your followers, Facebook, Twitter, any social media platform that you choose. Please feel free to go ahead and share. Okay, so let's start getting into some of the Greater Vancouver detached market data that did come out. It was quite the month. It basically eroded everything that happened positively in March. So March sale prices for the overall average were 1.709. And this last data of April came in at $1,597,000. So it basically eroded over $100,000 worth of equity gained. And now it brings the pricing structure back down to 1.60. So just before we go any further, I'll toss this chart up on your screen so we can kind of follow along here together. Today we're going to go over this chart a little bit more in depthly than we usually do, because it's very interesting on what's going on. And where we're going forward. Also, I got a question from one of our ardent followers, Rob. Him and his brother-in-law frequently listen to the podcast and debate it back and forth. Rob is a bit more of a believer that the market's going down longer term, where the brother-in-law believes that we're actually going to see a snapback recovery, likely even by the end of 2020. So we're going to go through this chart and kind of show some logic and technical rationale as to why I believe this market will be in the downtrend for a longer period of time. And then we'll give some fundamental realities that'll back that up eventually as well. So first, let's remind everybody where we came from. Initially, this market had peaked during January of 2016. All right, that's when the initial peak of this chart happened, of this current market cycle happened, I should say. And that was right at 1,825,000. Okay, the actual peak came in at May of 2017 with average sale prices of 1.830, as we all know. So what's interesting about that is, during 2016-17, nobody wanted to believe that the market was peaking. It was the market's, halting here, but it's going to go and stride even further into the stratosphere, which was interesting. For our ardent followers, our followers that have been with us since the beginning, you remember that we were published back in 2017 saying, no, 1.830 is the peak and the market will start to fall off and we'll be in this cycle for a prolonged period of time. In our first initial article in the Western Investor, we did say that the market bottom would occur in 2021. What's kind of odd about that is CIBC Bank just came out yesterday and said the bottom will be in 2021. So we appreciate them for joining the party a few years later, but that's okay. We got the same forecast now. So just kind of shows you the value that Eitel Insights does offer. And we'll get into that even further here as we deal with this current market cycle as well. So usually I do take the chart off. I'm going to leave this one up here longer today. Where we were after that peak was between 1.830 and 1.6 million, which is the yellow threshold, which is currently where we're at. That had held for 2017 and 2018, making a majority of the analysts and definitely the realtors believe that that was the low. We're not going any lower than 1.60 until 2019 happened. And in February, we hit 1.48, which is basically the 1.50 threshold. And what's interesting and odd about that is that had held, which totally makes sense. However, everyone believed that was the market bottom. What completely everybody forgot or missed out on was it was a stress test mitigation. That's why purchasing began at the 1.50 mark. That was a 20% reduction from the 1.83 million price point. When the stress test was introduced, remember, it slashed your purchasing power by 20%. So in essence, you had the market prices had to come down 20% just to mitigate those ramifications. So once that reality did come to the market, you did see a market base due to 2 years of basic pent-up demand. Once that demand was relinquished, we're going to see this market fall off. That is exactly why we kept saying, hey, please, do not be buying into this perceived strength. We want to be selling into it. And hopefully you did take advantage of that advice. I mean, hopefully you sold in March and received the average sale price of 1.709, which is the highest from the preceding 2 years. That's the kind of actionable intelligence Eitel Insights offers. It's not the stock market here, folks. Yeah, we did see that it was a near-term bottom at 1.50, but it's not something that you can purchase and sell out in a short period of time because it's a stock and it's very liquid. This is the real estate market. So you wanted to just be absolutely selling into that strength if you had a future challenge coming up with lower prices, which is going to be the inevitable reality here. So now we've already broken the 1.60 threshold, which is currently where we're at right now. I liken the pricing thresholds very much as a camel's back or a donkey's back. It'll take a great load, multiple stresses, but there will be one tipping point where it just is too much and the price is broken or the back is broken for the camel. That happened in 1.6 during 2019. During 2020, that will occur for the 1.50 mark, which will send us to the lowest end of the threshold, which is 1.40. That has been our base case since inception. Okay, so a 23% correction is absolutely going to be tested. Followers for us over the last year, you've known that we said, hey, 1.4 is almost a mathematical certainty, with a possibility of actually going below that back into a previously established threshold of 1.225, which was the higher green line on that middle market cycle, basically lasting from 2011 till 2014. So that would be absolutely historic, but this new reality could be very historic, and it would very much make sense. So let's deal with some of the fundamental realities here that the technicals don't necessarily take into place, but they eventually show up, and that's why we love technicals. So think about it. The fundamental reality during 2016, life's good. Real estate prices are screaming higher. Awesome. 2018, remember, the sale price or the car sales, high-end sales have been halted, slowed down at the very least, and the economic forecast wasn't as rosy. And that was okay. Everyone says, you know what, not a big deal. I can live in this new fundamental reality between 1.8 and 1.6. So it's still a high quality of psychological life. 2019, we tested 1.5, and you go, whoa, okay, that's a little bit worse than I was thinking or hoping, but I can get through this. 1.50 till maybe 1.6 for the near term, and then prices go up. So that's a mid-level of a psychological life. You know, it wasn't the high times, but we're getting through. We're doing okay. Now give this new reality what it's going to look like in the next year or so. I mean, we've been pent up in our houses for a long time already. And if there's a second wave, which by all reports seems definitely possible, that's going to impact this market and change our total way of thinking and our reality. It already has. There's been so many stories that will never actually open their doors again. What's interesting, I mean, so now we're in a place where everybody needs a little extra capital, right? The government's going to give you $2,000 in some cases. That's not enough for life in Greater Vancouver. In other areas of the country, it is. Greater Vancouver, it's not. That's just enough money to keep you going broke. So you say, you know what, I'm going to pull some of the equity out of the stock market. Well, it's down compared to 2 years ago, so there's no equity there. Okay, so you say, you know what, I'm going to work harder. I'm going to pick up extra shifts at the office or at the shop. Well, the shop owner has said, don't come into the shop, we're closed. So you can't even work your way out of this challenge. The last resort is to sell assets, sell your car, sell your condo, sell your house. And that's going to be the case that forces this market lower. Now, that is not necessarily the happiest or rosiest outlook, but it is a reality. And that's why we say 1.40 is a certainty. We're not going to go any higher from here. This new reality is worse than our old reality. Our old reality pushed the market down to the 1.50 threshold. So we're definitely going to go lower from here. One thing that's, worth pointing out is previous market cycles and always test their market lows, which are previously established prices where you're questioning that value at that period of time. That is exactly what happened during, the end of 2014, beginning of 2015 in our current market cycle. That threshold was between 1.40 and 1.50. That was one of the major reasons we weren't a believer that this market had bottomed. Every other time since 1977, it's tested that market low, not near the market low, the absolute market low. So this market had to test 1.40 before it goes higher. So hopefully that helps out Rob with the discussions with the brother-in-law. And you know, you can see on the chart here that this market is at the middle threshold that has been broken. So we're going to go back to lower levels, and just the way that 1.6 was broke, 1.5 will be broken because it's been tested previously, proved itself worthy, but now is sick of being tested and will actually give up the price point, and we'll go down to 1.4 inevitably. So now I want to deal with something that you know, is out in the media now. The real estate board is really in damage mode control right now, and it's interesting. And so are a lot of analysts that have already flip-flopped. So we'll leave them alone for a little bit, but we'll deal with the real estate board here right now. They put out that sales are down, which they're down historically. It's the lowest sales in April in decades, but we'll get to that later in the podcast. I'm going to deal with the HPI right now, which is the house price index, and it's the price that they quote to the media for whatever unknown reason. There's been other analysts and myself that disagree with ever using HPI, and I'm going to show you why here on the chart. I'll just put this on your screen here right now so everybody can see what we're dealing with. This is HPI versus average price, just the absolute straight goods. The orange data is the average price. The blue data is the HPI. Now we're going to deal with market peaks. We could deal with market bottoms, but it gets too convoluted and it eats up too much time. If you want an actual in-depth chart, please become an Eitel Insights clients. We do have a variety of reports available. And as you can tell, for the general market knowledge, we give you very actionable intelligence. You can imagine what you would get if you're asking about a New West, a Burnaby, a Coquitlam. We're spot on, folks. And we appreciate all the positive comments that our previous clients have sent us lately, especially all the private ones saying how much money we've saved them or made them in this last little market change. So we do appreciate that. But I digress. Back to the charts. The initial market peaks on average price inevitably show up faster than an HPI. So why would you use a lagging indicator for a prediction market? It just doesn't make any sense. And so we'll go through this, and then I'll give you a story that a media friend shared with me the other day. So back in 2008, the initial peak, according to the average sale price, was in February of 2008. The HPI took all the way until August of 2008 to peak. So the market had already fallen off before the HPI even was aware that there was a challenge. Same thing again in May, except this one's, unimaginably worse. This is actually a horrible example for the HPI and why one should never ever use it. You'll continually lag the market. During May of 2011, the average price had peaked. It took until April of 2012 for the HPI to peak. Now just notice on that blue chart where the second red dot is, look right above at the orange data. That's at market lows. So the HPI was telling you the market was peaking, but in all reality, the average sale price was at the lows. Not only that, but then the HPI fell off as the average sale price was rising up. So if you follow the HPI, you'll continually be left in the dust and be totally confused as to a true market reality, what's going on in current data. So that's why it's it is an impossibility to think that this new market had no price change month over month. So that's why the HPI hasn't shown it yet. Eventually it'll show it, but then it'll be a new news story, and they'll try and spin it some other way, which is very odd and interesting. But and then we go, of course, to go to our recent example. January 2016 was the initial market peak at 1.825, and it took until July of 2016 for the HPI to be aware of a same move. So you'll continually lag. Please don't use the HPI, and when you see the HPI quoted in the media, reach out to us at Eitel Insights to ask about the average price. One point of interest, when I was speaking with that media friend of mine the other day, we sent out the data, and we got a question back that says, hey, the board's saying that the price hasn't moved. I said, well, they're using the HPI. And I shared this graph with them, and they said, what's interesting is the board says that the HPI usually closely follows the average sale price. Well, okay, so you have the data, and the board has the data. I get the data from the board for average sale price. You have the data that is exact, but you choose to use something that maybe closely follows the data and share that with the media. doesn't seem correct for our line of work at the very least. So that's why we share that with you today. We will move on here to the inventory market. And I want to share a story with you that JR or Junior had sent to me. It was a capital J and a capital R, so I'm not exactly sure which name he wants to be going by. But it is an interesting story or an example of how bad the market is and potentially what you're going to be experiencing as a seller coming forward. Before we get into the analogy or the story, we'll just go through the data here. I'll toss this up on your chart here or on your screen. And the active inventory for the detached market did wane during the month of April. I mean, that's to be expected. We had social distancing. You couldn't really see your realtor. You couldn't really even see your buddy, let alone your realtor. So that was a challenge that will, of course, be eroded, and inventory will start to skyrocket here as this new reality of basically an economic recession continued goes forward. So we're just, like I say, just sub 4,000 active listings right now on the chart, but we're still above the staunch uptrend, and we will go higher from here. Now to the story that JR had shared with me. I'm not going to give the exact property address or MLS number. Please feel free to do so, I guess, in the comment section if realtors or JR is listening himself. It is good info, but I just don't want to toss anybody under the bus specifically. It is public info, so like I say, please feel free to share it if you're so inclined. But the story goes, back in 2018, there was a property purchased for $2 million, June of 2018. A few months later, this purchaser tried to flip the property, listed it for 2.2, couldn't sell, reduced the price down to 2 million, down to 1.9, down to 1.7, and on we go. Literally just recently sold from $2 million purchase in June of 2018. Recently sold for $1,075,000. This investor lost $1 million. It's not the way Eitel Insights likes to see an investment go, but this is a proven case how bad this market is for people that invested during the market peak. And that's why we're really doing this this podcast and giving you these worst case scenarios. It's not for the folks that purchased back in 2007. You already lived through your market recession during 2008-9. During this current market cycle, you can really almost take an ostrich approach. Put your head in the sand. Don't wake up for a couple more years, and the real estate prices will be back up to, the midterm to the all-time highs during 2024, 2025. So everything will be fine for you. However, for the folks that purchased during late 2015, 2016, 2017, 2018, this is who we're really talking to, especially 2016 folks, right when that market was peaking and it was just taking off. You're about to have a mortgage conversation in January, February, March of 2021. If you purchased average sale price at 1.830 and now it's down to 1.40, it's going to be a difficult conversation. So anyways, let's get back to the example. So it sold at $1,075,000. That, again, basically signals a $1 million loss. What's interesting or odd about this is this was a straight investment. It had to be. It was raw land. It was a spec property. So, that's somebody that completely timed the market wrong or incorrectly, and that's what Eitel Insights completely avoids. Again, by using the charts, we'll identify whether a market's at the top of the echelon or entering into the lower echelon, making it an investable market. So we are a believer in Greater Vancouver, just not at these current price points, especially in the detached market. Now, I will throw out this, not all markets inside of Greater Vancouver react equal. So Coquitlam Max is very different than Vancouver West. So again, for the individual reports, they're a nominal price of $250. If you do want yearly reports on a similar area, so say Vancouver West, instead of just a one-time report, you want monthly updates, that's only $1,500 a year. So it's very cost effective. And you get actionable intelligence right to your inbox monthly. So that'll go through the inventory. Now we'll get to the worst sales in April in basically decades. The sales total for April came in at 393. Ouch. And that's the reported sales at land titles. That's not even what the accepted offers of April was. I'll get to that in a bit. And that's, whoa, ouch. So the sales for 393, that's historic. Like I say, the worst April sales in decades. April is your beginning of your spring market where everybody, believes the real estate's going higher and better. Not so in 2020 for obvious reasons. But we'll just share some interesting data with you here. Like if you've been following us just so you've been over the past recent few podcasts, that the accepted offers during the month aren't necessarily reported. It is the actual sales at land titles. So the accepted offers during the month of January, beginning in 2020, was 520 accepted offers. February was 787, and March was 676. So these 393 completions that just took place that were just reported came from those data sets. What's interesting is April's accepted offers were a measly 213, which means going forward, we're going to have even more negative data coming out. Again, leading us back to our first conversation with Rob and the brother-in-law, why I do not believe that we're going to see a rebound by 2020. This market's very much in this doldrum phase for a while until we test 1.4 on a psychological pricing threshold. This market has no chance to go higher and sustain that momentum. We hope that you've been selling into this period of strength because this period of weakness is about to be upcoming. Thank you again for listening to the Eitel Insights podcast. We hope that you did find this information educational and a little bit entertaining as well. If you did find it as such, we ask that you do subscribe to the channel. Give us a thumbs up. Feel free to share this content with your friends and family. And stay tuned for the next podcast coming out shortly. Thank you very much.